Welcome to our High Rock monthly video for May. I'm Scott Tomlinson, and with me on the call today is Paul Tepsich, who is the portfolio manager and founder of High Rock, which was started in 2010. And we subsequently started our private client wealth management division in 2015. If you're interested in learning more about us, visit our website at www.highrockcapital.ca. April was a beautiful month in Vancouver with the cherry blossoms all in bloom. I am looking forward to visiting with clients in Vancouver next week. However, April in the financial markets were not so spectacular. Most of the asset classes were lower, save for gold and silver, and of course the preferred shares have continued to perform well. Paul can talk about that a little bit more, but led by U.S. equities, global equities were lower, and that also with bonds being lower, dragged balanced portfolios down. The fact that our clients in their balanced mandates have exposure to Canadian preferred shares certainly is helping mitigate that downside. So what was a great start to the year at the end of March has given back some ground. So trailing returns in the Morningstar balance category, the average of about 1,400 funds, only up 2.83% to date. Still up nicely over the 1 year period, but as we go back further in time, considering 2022 was such a difficult year, the 3-year and 5-year averages are lower than what we would consider to be something that would be much longer term. Anybody who wants to compare their portfolios with these Morningstar numbers are more than welcome to get in touch, and we're always happy to send you updated performance levels so you can compare what your portfolio is doing on a relative basis. Let's go and talk a little bit about the high yield and preferred share mandates. Paul, over to you.
Yeah, okay, we'll start with high yield. It was, I just wrote the note to all the high yield investors yesterday. It was a very short note. Nothing really of substance. We had a couple bonds that we knew were going to be called from us that were refinanced with new paper, new bonds. And really that was about it. You know, we've had a spectacular run over the last number of years with an overweight in energy bonds that were trading way below par and have gravitated back to par, and in many cases been refinanced with lower coupons. So moving forward, as we've told the investors, likely to be more of what we call a coupon year as opposed to a big capital gain year. On the preferred share side, we have had a great move. Most of our investors came in early to mid-November. It was not quite the bottom in the preferred share market, but we've had a spectacular move. Now, I'll just say that we ended up getting in the preferred share mandate, we put in 3 bank prefs worth roughly 10% each line, so roughly 30% just in bank prefs. Banks have started redeeming their 5-year rate resets, and we are likely over the next year and a half going to see about $7.4 billion in bank prefs taken out of the market. It's substantial. So our balanced clients, also we put those same 3 prefs into our balance mandates. We've been very overweight preferred shares. That's been intentional. And it's really through these 3 bank prefs. And just to give you an idea on timing, a TD comes for a reset in July, a BMO comes in November, and a Commerce one comes in January. So right now we've seen several called or redeemed, and what's happened is all these big large ETFs, preferred share ETFs, need to go out and replace use that capital and replace it with new prefs. So the whole pref market is going to get a lot smaller, and I would bet in 5 years' time doesn't even exist. So it's putting in a very good support bid under the market as these big ETF funds have to redeploy the capital, and they'll look at insurance prefs, they'll look at corporate prefs like BCE, Enbridge, TransCanada Pipeline, etc. So that's kind of the big news, both in the special mandate, preferred share special mandate, and in our balanced portfolio as well. That's it, Scott.
Excellent, Paul. That's great. Thank you for that update.
I would just add that this within our balance mandates, when you go back and talk a bit about performance, and I won't get granular with it, but I will just say that if our clients look at their performance in the month of April, that was why your performance looked much better than the market, and may have still had a very small minus sign in front of it for some. But given what happened with bonds and stocks, that really did cushion the blow. And so we're very happy with this trade.
As we like to say, some of our non-correlated assets that we put into our client portfolios definitely help to mitigate downside when other markets are under duress. And certainly, as always, we like to focus on the long term as well. We want our clients to continue to have conversations with us about their long-term planning. We want to make sure that what we're doing with your asset allocation strategies are meeting your long-term goals. So it's incumbent on you to get in touch with us to make sure that all of this is going in the right direction. On the economic front, Paul, inflation's still an issue at the central bank level. We'll get to the US in a second, but close to home, Bank of Canada focusing on what's happening in the inflation environment in Canada as they move towards their next policy meeting, which we expect to see perhaps a quarter point cut in the policy rate in June. And that, if that doesn't happen, it will be based solely on one particular situation, I would imagine, right? Shelter costs.
Well, yes, as you can see in that chart there, and I think at some point those will come off dramatically. But so you just look at Canadian inflation without the shelter costs. I mean, wow, we're down at 1%. So the shelter costs include mortgage payments. So the fact, one's driving the other, rates are up, well, mortgage payments go up. Rents are obviously up as well. But the other thing that is driving it is really this tug of war that we are seeing both in Canada and the US. Like, I believe the bank would love to cut rates and provide some sort of relief for the consumer, who I believe is completely tapped out. But with the federal government running a $40 billion deficit coming up this year, and God only knows what the US deficit's going to be, but you've got fiscal policy from these governments running these huge deficits being stimulative, which stimulates the economy, stimulates inflation, and buys a lot of votes. And then you've got these central banks going, well, it's hard for us to cut rates when you're stimulating the economy with fiscal measures like they are. That, I think, is a problem.
Got it. And now, again, talking about the US, the Federal Reserve met yesterday and basically said that they're on hold until they start to see inflation moving sustainably toward 2%. I would imagine that's something that, again, with your thesis on fiscal or lack of fiscal restraint, that puts the U.S. Federal Reserve in a difficult place.
Yeah, no, agreed. Same thing as in the US as in Canada.
Yeah, absolutely. So while we're waiting for all this to unfold, at this juncture, let's talk a little bit about global equity strategy. As I talked about at the beginning of the year, in the first few months, when equity prices were hitting new highs, we were leaning towards taking sales, especially as we rebalanced client portfolios. Um, Stock prices globally have come down. We're not necessarily putting on our buying hat immediately, but we're definitely getting closer to rebalancing the other way now to use cash balances in client accounts to perhaps add equity positions. So we'll keep you posted as that comes to fruition. But we're liking the fact that from a buying perspective, that prices have come down. Paul, tactical strategy.
Not much to add in the tactical model. We're kind of going through some earnings right now, so there may be some further opportunities. One of them I just got off the call this morning. Yeah, I think there's I get the only highlight again, Scott, would be the Source Energy bond, which is really now back at par. And I spoke to the CFO last week. It is a bond, but we consider it equity. I did speak to the CFO last week, and when we were talking about the bond and it potentially being refied because its maturity is March 2025, so it's under a year. So it's time for him to do something with it. He would have bought it from me at par in a heartbeat. Obviously, I didn't sell it to him, but that has been our standout trade over the past couple of years. But again, it was in a very measured weight. So it wasn't a huge position for most people. Some, it was much bigger. And certainly for our high yield mandate, that position was, it's our largest. So it's been spectacular. That's it for tactical. I really don't have anything else to add. And fixed income, again, bonds have yields have climbed, prices down, both in governments, investment grade a little bit. High yield are kind of sitting pretty flat, okay, and we're collecting a decent yield and coupon. And then, of course, preferred shares, which added huge value over the past number of months, which is really just really accentuated its our thesis just even over the past 2 weeks. So that's the standout in fixed income. That's
Excellent. Excellent. Okay. Well, thank you for that. And as always, we want to take a moment to thank everybody for tuning in, taking time out of your busy schedules. We'll certainly be back with our next update at the beginning of June. I'm Scott Tomlinson, currently in St. George, Utah. Our High Rock sponsored athlete, Miranda Tomlinson, competing in her first event of the Pro Triathlon Series, and so we're here to cheer her on, and then heading to Vancouver, as I said. But anyway, on behalf of Paul and Diane, we want to wish you all the best for the month of May.
And we wish Miranda the best too.
Yeah, I'll pass that on, Paul. Thanks.
Good luck.